I'm Charlotte McLeod with investingnews.com, and here today with me is Josef Schachter. He is president and author at the Schachter Energy Report and a 40-year veteran of the industry on both the buy and sell side. Thank you so much for being here. Great to have you.
My pleasure. Good to be with you again, Charlotte.
Nice to be catching up with you. It's been a little while, so there's a lot for us to go over in terms of oil and natural gas. But where I thought we could start is you have your Catch the Energy conference coming up very soon. So I wondered if you could share some details on that, what people should know, how they can attend.
Yeah, we have annually a conference at Mount Royal University here in Calgary called the Catch the Energy Conference. And what it is we found that for individual investors, access to management is very difficult. Institutions get a lot of attention. Companies do roadshows. The big banks and the energy firms all have conferences, and so they have access. Individual investors don't. So our product was created on the research side to cover companies in the energy service, royalty area, so domestic and international E&P, so that individual investors have an independent view where I could use the four-letter ugly word sell and or void if it's an issue right now that we're concerned about on a company. And the conference gets 30 to 40 companies. This year we'll have 33 companies coming. We had more, but if there's deals, they're precluded from presenting. And we have a whole mix of companies. Again, people can go to the website, www.catchtheenergy.com. And for those who want to be subscribers so that they get our research product, our independent research product. And again, Q3 results will start in the next week or two. So it's going to be a lot of input for people. And if they own the companies that we cover, number one, come to the conference. You can talk to a Mike Rose at Tourmaline. You can talk to a Chris Carlson at Birchcliff. You can talk to a Dan Halleck at Total Energy. You have the access to the management. So if you own the stocks, having that face time to ask your questions and then see the look in their eyes as they answer your questions, that is so valuable to an investor to have the comfort to stay with the story if they believe the long-term potential. And that's really the benefit of it. So people can go to www.schachter, SCHACHTER, energy.com and SchachterEnergyReport.com, and they can access the subscriptions. There's a special offer for INN listeners that Sarah Dixon, our manager subscription, put forward, and they can get 2 tickets if they to come to the conference. We're almost filling up, so we're close to putting a wait list in. So take advantage of it if you want to come, and if you can't use them, pass it on to family or friends who can come to Calgary. And we think it's a very, very, good value for investors if you have an investment in any of the companies that are there, just to talk to the company you do own. And if you own multiple companies that are presenting, it's unbelievably a valuable opportunity to have that face time.
Perfect. So this is coming right up. We'll have the links in the video description if people want to check it out. And I agree, so valuable to get that face-to-face time with the companies. So we have that coming up. And now let's jump into what's going on in the oil sector. So I mentioned we're catching up after our last conversation all the way back in May. So there's a lot that's gone on since then. And what I was wondering if you could do just to start is pull out any key events that you would want to highlight for investors over that course of time. What are the main points that you think people should be aware of?
Yes, I think people need to realize that at the beginning of this year, we were trading in the high 70s, 78, 79. And we got cautious because we saw inventories building in the U.S. as we talked in May. And also we saw inventories building around the world faster than they normally do seasonally. And so we said the price of oil is probably going to go down. And we had a call saying we think it could even go below 60. We didn't know Donald Trump was going to do his tariffs. And of course, the price of oil went down to the mid 50s. And then in April of the year, we saw that stocks were really cheap. The price of oil got to a point where people were shutting in and production and not not spending money drilling. And we thought that was a bottom. And there was something called the S&P Energy Bullish Percentage Index. And when it's in the 70, 80 range, then, it's telling you people are optimistic. When it's below 10%, that's a buy signal. And if you get below 5%, it's a table pounding buy signal. We've had 3 and 4% in 2008 and 2020, at the bottom, if you remember March, April, then we had in April 0% bulls. Unheard of. I've never seen that in my career. And as you said, 40 plus years. So we sent out an action alert buy, added some new buy names, reiterated buys on others. And of course, that's worked out very, very well. And I can go through examples if you want. And right now we're a little cautious again. The price of crude got up a little bit higher. We're seeing inventory builds, in the data. And we're still in that seasonally weak period before winter. So if winter hits in mid-November or early December or January, once that cold period starts, demand picks up between 1 million to 1.3 million barrels per day, between the shoulder season and the winter season. And so if we're going to have an average of 105 million barrels, that becomes important to the price of oil at the margin. And my view is winter we'll see prices north of 70. And I think that in second half of 2026, we're going to be seeing prices in the 80s. So our view is the buying opportunity will come sometime during Q4, probably late Q4, during that window when we talk about tax loss selling from mid-November to mid-December. I think that season is going to affect some groups, and some energy stocks have not done well, so they would be harvested for the gains. If you made them in AI or MM stocks or whatever, you're going to want to not spend so much money paying CRA. So you'll want to take your losers and offset them and maybe buy something like it, a different name in the sector, so you stay exposed to that part of the energy sector. So we're in the camp that hold off now, keep your cash reserves. We're going to probably get a great buying opportunity, and our subscribers will send out, an email to everybody saying an action alert. It's time to buy. And here's the 3 reasons. 1, the price of oil gets down below 60 into that 56 to 59 range. That would be one trigger. 2, the S&P TSX Energy Index, which is in the 290 range, probably below 240. And the 3rd, that bullish percentage index getting below 10%. If all 3 of those check marks come through, we will be sending out an action and buy alert. And that's something that I think we add value, because, we've been doing this so long. We have our metrics that we watch, and the metrics tell you when it's time to buy. It also tells you when things are frothy. And right now, we think you hold your powder dry, have some cash reserves, you have dividend income coming in or whatever, because the sector is paying very, very nicely in terms of dividends, and then wait to allocate those to the names you like. And, look at our research. Maybe you'll find a new name, or come to the conference and maybe you'll find a company. Wow, that's a great story. And then they could then be ready to buy when we get the appropriate indicators kicking in.
Very good. I think this is essentially exactly the direction that I wanted to go in, because I do remember we had talked about that buy window in May that was coming up at the time. And I wanted to check back and see, okay, so how did you end up playing this? What did you do? How did it pan out? And then talk more about how to position for this next one. So anything you would add there?
Yeah. So in April, we started the month at 72.28. I've got the charts in front of me. 56.06 was the low. In the second week of May, the bullish percentage index went from 82% down to 0, as I said before. But just showing you some of the stocks, Alvo Petro, which is in Brazil, a natural gas producer, Canadian oil producer, the stock was down at 438. It's, 674. So it's up 53% plus a very, very nice dividend. Freehold Royalties, which is, has Canadian and U.S. royalty assets. They pay a 9 cent a month, dividend. So a nice annualized there. The stock went up 39% to the $14 level, from the, $10 level, just above $10. Plus you've got a very nice dividend. Hemisphere Energy, a Vancouver-based energy company, Don Simmons. The stock was trading at $1.52, 224, 47% plus dividends. And then I'll give you probably the winner. In play oil was down at trading at $5.20, $13, so up 107% plus dividends. And one more on the oil side, Surge Energy was $4.19, $7.40, up 77% plus dividends. So, and Total Energy, a service stock, going from E&P to service, the stock was trading at $8.20. Now it's trading in the 14.5 range, up 77% plus dividends. So taking advantage of those triggers when they come, and then we highlight the names that are the bargains. And every issue that we do for our SCR, we cover what the top picks are, one from each sector, from being the royalty side, domestic Canadian natural gas, domestic Canadian liquids, energy service, and then international. So we have 5 sectors that we watch. Because I'm cautious in the near term, we only had 2 buys in our issue that came out today. So we're being more cautious, saying, wait, be patient. And if you do, and then you know the names, you keep up with the names, when the buy signal comes, you will have the confidence saying, really, I love Total, I love Surge, I love In Play, love the stories. Now I got a buy signal where I can buy the stock cheaper than it was just a month ago. That's the story we're running with.
That gives a good idea of how you're strategizing. And while we're on the company angle, I want to check back on M&A activity, because when we had talked, you mentioned maybe coming up into the second half of 2025 into 2026, we might see increased deal activity in the oil and gas space. So how are you seeing that play out? How is that looking?
Well, we're seeing the battle for, Meg Energy right now. And does Strathcona come in with a higher bid? And, one of the problems with the Cenovus bid originally was shareholders wanted to have stock. They wanted to be involved in the upside of the story. So now it's half and half, cash and half in shares of Cenovus for the new deal. And then October 20th is now the cutoff date for the decision to be made by the shareholders of MEG. I see other companies which are looking at strategic reviews. Kuwaitno is under one. They've announced that. They've been in the process. I think, we've seen, Step Energy being, got a takeover bid from ARC Financial, $5.50. The stock was trading in the 4.5, popped $1, close to $1 on that bid. I think there's going to be more and more, especially as LNG Canada moves to 2 BCF, which is an issue we can talk about. They're now much below that, maybe only 500 MCF, not the 2 BCF that needs to happen. If that happens, that'll raise the price of AECO, and then the people who might be sellers will then get bids that are more reflective of the long-term value of those assets. Right now, with the price of natural gas at 50, 60 cents for AECO, are you really want to buy that? If you can get somebody to be a seller, but most of the sellers will say, hey, I think my long-term value is $3 an MCF. You pay me for that, I'll do a deal. So I think we need to merge those numbers, and get more reflective of the true value. If you look at the U.S., the U.S. is, 340 something. An U.S. NYMEX price. Well, move that into Canadian dollars minus transportation. We should be north of $3 on an equivalent basis. But until we tighten up supply and demand and start bringing down our inventories, we're at record, total levels. Cold winter will do that, and LNG Canada going to 2 BCF a day sometime in 2026 will raise the price, and we shouldn't see negative pricing and low pricing going forward from 26 on, with everything on hopefully by Q2 of 2026 for LNG Canada. So I'm optimistic longer term. Near term, a lot of the stocks, some of them are depressed, not near their lows for the year, simply because of what's going on with the cheap natural gas price of AECO.
Anything further you'd add on the LNG Canada angle there? Because you'd mentioned before we turned the camera on, this is a really important one to pay attention to.
Yeah, the target production level is 2 BCF, and how important that is the industry produces in Western Canada 18 BCF. So that's a big bump up in terms of total demand. We also have more demand from SAGD. We have more demand from power. So everything in longer term looks really good in terms of the boxes you check to say, here's what I would need to feel really bullish. But LNG Canada has birthing pains, just like most of these projects do. So the first train is being, taken care of now, repaired, and it's ramping up. I think we've now had like 15 cargoes, moving already. 16th is being loaded and will probably ship in the coming days. LNG Canada is now announced that Train 2 is getting ready to produce, and they've told the shippers or the buyers of the LNG, send your ships in late October, November, and we'll start filling. I think they can fill 10 or 11 a month between LNG Train 1 and Train 2. So that's going to be number one, a big increase in demand for the industry. Of course, that's going to mean more tax revenue for, the BC government, and it'll be a lot of new revenue for the companies that are providing the LNG. And of course, LNG Canada, if they're producing with 2 trains, they're going to be much more profitable. So it's a win-win as they get that resolved. And Shell is the major player with LNG Canada, and they know how to do this. They're one of the biggest LNG operators in the world.
This connects, I think, to another point that I wanted to check in with you about, which is we have our relatively new Prime Minister in Canada, Mark Carney. And I think I asked you this earlier in the year when we talked, how is the oil and gas industry in the country likely to look under him now that we are some months in? Maybe you can give us a better picture of what we're seeing pan out at this point.
Well, on the positive side, Carney, is wanting to do major projects that will increase the pie for Canada, increase the wealth of Canada. He knows we're a resource base. So you saw those project announcements, which include LNG Canada, phase 2, which would bring on 2 more trains, by the, 28, 29 period. We also have, Cedars LNG moving forward, Kissimmee moving forward. So potentially by the end of the decade, we could have 6 to 8 BCF of production on the west coast of Canada. And again, compare that to the 18 BCF produced right now. That's a big uptick in demand, which will impact the industry. And a lot of drilling will have to occur to fill it, which means jobs, which means tax revenue. So it's a win-win for everybody, First Nations and the, BC government and the company. So it's a win-win across the board. So I'm positive on that side of it. The one area that people are still upset about is some of the bills that have been passed that have not been reversed. Bills that were put in by, his predecessor, Justin Trudeau. And so the industry is saying, right now, you're saying the right things, including recently we just heard about the XL pipeline might be, I think he did that to kind of sweeten the deal with Trump saying maybe we'll come and resolve the tariff issue with Canada, because he was a big proponent of that. And again, there's still issues with it, but South Bow said, which would have been the owner of that. There's things that have to be done to get that back on track. It's going to be more costly, all the other things, but regulatory issues, land tenure issues. So there's a lot of issues to go through. But the fact that they're even talking about something like that is a positive. Our premier is working with the federal government. And even though she has a little bit of a tiff with your premier, right now over, future growth, with pipelines going to the coast. And again, all access for tankers in the northern part of BC is a big issue still. But I think that, the province is going to try to work, the industry is going to try to work, with the federal government. And again, the federal government is going to have a massive deficit this year. So they have a real reason to want to increase the pie, increase the wealth, increase the tax revenue that they get, so that they can, at some point in our grandchildren's lifetime, they may have a balanced budget again.
Nice context on what we have going on over here in Canada. You started to talk about Donald Trump and the US, and I think that's a good place to look at as well. last time we were speaking, it was still, we were hearing a lot about drill baby drill and the dynamics there. And I was reading recently, the EIA is predicting, I think, record shale production out of the US this year. So I wanted to ask your thoughts on what we have going on there and the sustainability, because the price levels that the companies need, if we're at these lower levels, might not be working in their favor.
Well, the EIA data from last week showed that the production level in the U.S. was 13.6 million barrels a day. That's up from 13.4 million a year ago. So there is an increase in the liquids production from their oil side. Also, the natural gas liquids are up 123,000 to 7.7 million. So when you add the two together, there's 10 million of production in the other supply, which is renewables and natural gas liquids. So we're 23 million, 23.5 or so million production. Demand is only like 22 million. So the U.S. is a net exporter, and exports last week were 3.59 million barrels. So the light barrels that are coming out of the Permian and Eagle Ford are being shipped overseas, while the heavy crudes, from Canada are going into the refineries that have always been, using heavy crude from, Mexican Mayan or Venezuelan heavy. And then the Canadian market benefited because Venezuela got cut off. Mexico's fields got matured, and not enough money was spent to develop new reserves and bring them on production. So Canada was the big beneficiary of it. We now produce 6.1 million barrels. People should take into account that we are a powerhouse. The biggest producer is the United States, as I mentioned, 23.5 million. Then you go to Saudi Arabia, and they are a producer of 9.7 million barrels per day. Then you go to Russia, 9.2 million barrels a day. Then Canada at 6.1, and then you go down to China, which is like 4.5. So we are a powerhouse. Plus, we have security of supply. We are closer to Asia in terms of the ships taking it from the West Coast, if that can ever happen. Our resource base, we have some of the biggest reserves in the world, both of oil and natural gas. And, our Montney and Duvernay are bigger than the Permian and the Eagle Ford and, the other, Haynesworth and all the rest of them down there in the U.S. So the upside for Canada is substantial, assuming the go-ahead happens with more takeaway capacity. I think the story longer term is fabulous. The question is, can we get through some of these issues? And I think the fact that we're seeing First Nation support, First Nations wanting ownership, that's a positive. Two, higher prices means more royalty tax revenue to the government. More jobs means more tax revenue, and more jobs means and higher paying jobs, high paying jobs in the industry. So there, everybody should have a piece of the pie and grow the pie. And that's what potentially could happen down the road. But, the industry is, we need to get, LNG Canada running at 2 BCF and then get all the provinces and the federal government on the same page for growth.
You can really see the potential for Canada there. So we'll have to wait and see if all these factors can align. I also wondered if you could put what we're seeing from OPEC Plus into context, because I think we saw an output hike for November, but less than was expected. So how is that fitting into the supply picture for you?
Well, OPEC throws out numbers, and when they do this, they talk about quotas. They're not talking about actual production. And many countries have quotas that are above what they can produce because they don't have the money to reinvest in the industry, because the cash flows that are coming in at the, Brent, whatever they're getting, doesn't cover the needs of the government, be it social services, be it for their military, be it for the graft, so the cash flow that's coming in is not being put back into the ground, and that's not causing growth in their numbers. So, if you look at Saudi Arabia in Q1 of 25, I have the data in front of me, 8.95 million barrels. The August production was 9.7. So they have taken up and increased their production. I think their capacity is only like 10 million. And so once you have that next 300,000 come on, the only way there's more production is if they have storage and they move the production out of storage and put it into daily production. And I'll give you the example of 2008. The price of oil at the beginning of 2008 was trading around $85. And in 2008, it ran in the summer to 147, a massive spike up. And the stocks all reflected, the rising price. And it was a very fabulous period for investors during that period of the first half of 2008. And Saudi Arabia was producing in 2007, 8.65 million. And by July, at the high, 9.52. So they were able to grow by about 900,000 barrels a day. And if you look at what they're doing right now, they're, 800,000 barrels a day. So you add maybe another 300 and then they're at peak production. And so I think once the world knows in 2026 that we are at peak production in OPEC and more money needs to be spent to add. And of course, drilling is first thing, then infrastructure, pipelines, all that stuff needs to happen. That's a costly exercise and a time-consuming exercise. As we know, how long did it take Coastal, to be built? How long did it take TMX to be built? Cost overruns, length of time to build, all the rest of it. So I think that we're looking at, 2026 in the second half, very bullish story. And that leads into multi-years in 27, 28 into the end of the decade. And the big thing to realize is we're growing demand globally by 1 to 1.3 million per year. It's not the OECD. The OECD is flat and probably will be declining because of, the climate issues and the ability to switch to EVs and all that's going to be less demand for crude oil. But the world outside of the OECD, be it South America, be it Africa, where we want more copper, we want more nickel, we need more aluminum, copper being the big one, because if you want to upgrade the grid, if you want to have, the data centers, you're going to need copper for that. And all of those things are going to have to come from the third world. They're going to want a rate of return that's right for the countries. They're going to want good jobs, high paying jobs for the people. The people want to go from a lower standard of living. Maybe they're on motorcycles or bikes to cars. They're going to want to have, home heating. They're going to want to have electricity. They're going to want all the things that we want and have. And so that's going to be fair. And the price that they're going to need to build it and justify it means the commodity price have to go up. All of that is going to require more energy in the non-OECD. And I think that is the bullish case for the long term. And I think that we could see by the end of the decade, instead of the 105, we could be 110, 112, but the OECD numbers will be down, but the rest of the world will be up.
I think that's so important to remember on the demand side. And again, you're going in the direction that I was hoping you would. I did want to touch a little bit more on the demand side. So we had talked again last time about potential for a recession in the US, which I don't think you are really seeing in the cards, but also about black swan events that could affect the broader economy, could affect demand. So I'm wondering if there's anything you would bring up on that note for investors to keep an eye on.
We're seeing slowdowns in a number of economies where jobs are coming down. Germany, we just had data come out today talking about the auto industry pain and the industrial sector pain that they're feeling. We know in Canada we've got job losses because of what's going on with tariffs. U.S. job losses we've seen with the different reports, the ADP report and others, even though the government shutdown is not sending the Bureau of Labor Statistics data out. So we're seeing that happen where there's jobs losses, but there's growth in other areas. AI has had such a tremendous impact on the industry with the massive amount of spending, all of the new chip factories that are going to be built in the United States, for NVIDIA and AMD and all the deals we see happening there. So there is some growth in the tech sector. Is it strong enough to offset the declines in other sectors? I don't know the answer to that at this point. But, we saw the Q2 number for the U.S. GDP revised from 3.0 to 3.8% growth. So there is growth in the U.S., even though we have all these travails. Canada, though, might see negative numbers, or, kind of just, going between up and down, flatlining. Germany will be down. France will be down. So the industrial world is seeing the weakness. But the non-industrial world, I think, is seeing the opportunity for job growth, for growing their GDP, all of those things. So I think, are you looking for a decline like we had in, the Great Recession, 2008, 2009? I don't see it. Do we see, things like 2020 during COVID and that impacted, energy? I don't see that. But a pullback into the 56 to 59 level because of soft demand and growing supplies, I think is probably in the cards. But heading into the latter part of this year and 2026, you want to be invested. So anytime we get a buy signal and you like the sector, plus the dividends are pretty extraordinary. You're getting companies yielding 7, 8, 9% to right now. Some paying quarterly, some paying monthly. That's pretty good relative to what you get in the bank. And if oil does go to 80 or 90 in the next 3-4 years, and natural gas goes to 3 years, cash flows will go up, and they'll either use it for, growth. They'll also use it for their NCIBs, and, of course, issuer bid, buying the stock back, and for dividend growth. So, I think we're at an apex where anytime you see these buy signals, you've got to get to whatever a fair position is for you, depending upon your risk profile. Sit down with your investment advisor to see what's appropriate. But you can get good yields in pipeline and infrastructure, royalties, E&P companies, domestic. So I think that, people should be considering the sector. We've had great runs in, precious metals. We have great runs in the MEMS and the AI and the tech sector. But as I showed you from the, April of 2025 bottom, we had some pretty good performance in the energy sector, not a sleepy area, when the buy signals kick in. So, when we get this next buy signal, I think we're going to get some great opportunities, for investors, and we'll be highlighting that in our reports.
Yeah, I think you make it sound very straightforward what we all have to do here. And just before I let you go, anything further you'd add on the note of pricing? So $80 oil is looking like a story for 2026. On the natural gas side, is there anything that you would add?
Well, U.S. natural gas and Canadian natural, two different, apples and oranges kind of thing. The U.S. price in the 340s, is normally what you see during the, soft periods of the, the shoulder seasons. And then you get into winter, you can have spikes to $5, $6, $10 even in the past. So my guess is that if we have a normal winter, we might see $5, NYMEX during winter months of, January, February, when you get those big drawdowns of 200 BCF or more a week. Potentially if it's a cold winter and there's a lot of snow down in Texas, which doesn't have our insulation, we might see $9, $10. But $6 is what we're saying for, peak pricing right now. And again, we'll see what Mother Nature has in store for us as we get closer to November, which is the beginning of the draw season for natural gas. In terms of Canada, we need to see LNG Canada running at full capacity to tighten things up. And if we have a normal winter, our drawdowns of our storage will come down, and we'll get back into the 250, 350 range for ACO, and Station 2 during those winter months. And then if LNG Canada is running full out by the end of winter, which of course, means March, then we could see prices come down from those lofty levels, but not down to negative numbers like we've seen, this past fall. And maybe the shallow periods now are $1.50 to $2 rather than low 50 cents, 60 cents and negative pricing. So I'm optimistic for that. On the high side, $3.50, $4 would be probably where we are during winter 2025, 26. But winter 26, 27, if we're running at 2 BCF in LNG Canada and we have other projects moving forward and storage has been pulled back, and demand picks up for SAGD, demand picks up for, power for data centers, we could be looking at, winter prices in the $4, $5, $6 level. And we could be looking at, the shallow periods only being $2.50, $3. So the story gets better and better further down the road. We got to get through these next couple of months here. But, if we get you get the pullback that I'm expecting and we get the buy signals, we are telling our subscribers that, if you were at 80% of where your target level is for the sector, we think we're going to be recommending whatever is appropriate for you. And again, sit down with your investment advisor, see what is appropriate for you. What do you want? The biggest names, the most liquid names, like a TC Energy or an Enbridge, or do you want, a big name like Tourmaline or other names that are in the sector that have a good dividends, domestically, Freehold, Royalty, and Topaz, and, names like that, then, be ready to buy when we get the next buy signal. And, my view is I don't trade. I'm not a trader, but what I like to do is take advantage of those low risk buying opportunities to build my portfolios. And right now, for myself and my family, we own 11 different energy names, and we may add one more, but I'm just building positions, taking advantage of which ones are the bargains when we get those buy signals, and then you build up your portfolio for the long term. And it's nice seeing those. And I would say that over half the names are dividend payers, so I like seeing that dividend income coming in on a regular basis.
I think, of course, as you said, every person is different, but this is a really good action plan that I think people should take a look at. So, very solid conversation. I will let you go. Any final points? It seems like we've done a good job covering oil and gas for the time being.
Yeah, energy is one that doesn't, is not something you buy and hold like you thought maybe IBM or, or a Meta or something like that, Microsoft. The energy sector has its cycles. And we had a bull market cycle from 74 to 81, and then it went into a dead period, and it was a trader's market, not an investor's market. 99 to 08, we had a massive cycle because China became, capitalistic under a communist umbrella, and their demand went from 4 million barrels a day to 14 million barrels a day. That incremental demand drove prices up to that 147. Then we got the COVID, and 2020, we got the bottom. I think that's the beginning of the new cycle. This cycle might last to 2030, 2035. I don't know at this point, but it'll be because of the third world. The non-OECD world will be consuming more and more energy as they build out the products that we need. Aluminum, lithium, all the things we've talked about. And that's going to be the driver, and that takes many years. So this is not a 1 or 2 year cycle. So if we're going to have a 5 to 8 year cycle, then what you want to do is nothing goes up straight. There's always corrections along the way. So during those corrections, that's what we use our 3 metrics on. And when we get those saying buy, then we say add to your portfolios at this point. And so far in my career, that's worked out very well.
Well, great, solid point to end on. Thank you so much for coming on to talk. It's always great to have you.
My pleasure as always, Charlotte. And wish everybody a happy Thanksgiving.
Oh, thank you very much. And once again, I'm Charlotte McLeod with investingnews.com, and this is Josef Schachter.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.